Hi, I'm Peter Rose, founder of Longwood Currency Trading. Today I want to chat with you a little bit about how to think about and achieving daily profit goals. You know, you look at your trading as a continuum of activity, and probably one of the better ways to look at that first is on a daily basis. Then you look at your monthly totals, and then you look at maybe your yearly goals. But if you're going to look toward the yearly goals, you kind of sort of got to figure out, how do I get some kind of a daily goal that adds up to that? So that's what I'd kind of like to chat with you about today. But first, I've got to go get the bow dog. Sue's out walking the bow dog in the woods on a trail, and so I got to go pick him up so she can continue on with her day. And I've got a position that is pending. All I'm waiting for is my little beeper to go off. So we'll have to get back to that. First, let's take a look at the wood that got dropped yesterday afternoon. And we got 2 more cords to come. I'll be all set for the winter and probably the following winter. There he is, back home, waiting to go in, and it just, I'm jarring around here because it's raining. But first, I got to get my coffee, then we're going to go into the library and get on with this thing. All right, profit targets. The first thing you have to understand is you don't have any control over your profit. So calculating what you're going to make on a yearly basis, or even much less a daily basis, is really difficult to do. The only thing we have control over, is our risk, and I've said that many times. So if all we can do is control our risk and hope for the best on the profit target, the assumption is that if you're going to trade, you're trying to make money. You're trying to replace your job income. So you start maybe with trying to pay your light bill, a couple of $1,000s a year, with say a $10,000 account, trading one full lot. Again, you need $6,000 margin, and so the $10,000 gives you $4,000 of runway to make mistakes. That's 400 pips. You're not going to go wrong for 400 pips. If you lose 300 pips, you're going to probably figure out what to do, okay? So you don't need 10,000. I use 10,000 for other purposes because I'm trading a 6-figure account. So when I get up in there and the price is really running, I want to be popping that bid ask and loading up the bus and really going for it and pressing the risk, because every time I stage in, it brings my average position value closer to the current price, and so a retraction in that price can be catastrophic if you're loading to the top end as opposed to loading at the bottom end. But you don't want to load at the bottom end and then take a 20 pip hit against a 15 lot position, right? Because you're losing $3 right off the bat. So when we're working with large scale lot sizes, it's a little bit differently the way we would trade if we were trading on a single full lot, or maybe 3 full lots or something like that. So let's just talk about that one full lot. Can you make 20% on your money on a $10,000 account, which would give you the $2,000 a year that you need to pay your light bill? Again, you don't need the $10,000 to do that. Maybe you could go in with $7,000. But look, if you're learning this stuff, you don't want to be fearful about running into your margin. So look, you don't have to have $100,000 down payment to buy a $200,000 house. You don't have to. When I bought a condo in Dover many years ago, the price was $190,000. And all I needed was $20,000, and I could have bought that condo. I didn't, because I didn't want a large mortgage payment, because I thought if I lost my job, that would put a lot of stress on me. And so I put $100,000 down on a $190,000 condo, or $180,000, and carried an $80,000 mortgage. It cost me $620 a month for my mortgage. And I did end up losing my job. I had my real estate to supplement the income that I needed to have until I found another job. But having a $1,200 mortgage plus my real estate taxes and condo fees and all the rest of it, that would have hurt. I would, that wouldn't have been a good thing. So I took the $100,000 and I put it in there. So we're talking about doing the same thing with our trading. And the reason I'm going through all this is because I'm setting the stage for what we're going to be talking about, how you migrate your thinking toward how much do I need to make a day, and how do I go about being confident that I have the skill in order to do that, okay? So let's swing into the library and go on and do some stuff on the whiteboard. Okay, so look, the video is going to be a little choppy because I'm doing this on the fly. I just want to talk you through it the way I would talk you through it if you're sitting in front of me. I will break the video when I go to write up an equation or something like that, so that so you may hear me call break, and then it'll cut out and come back to you. All right, we've got a here's the scoop. We've got a $10,000 account. We want to make $2,000 a year on that. There's 200 trading days. In a year, but we're going to assume you're going to only trade for, let's say, 100 of those days. Okay, so that's our first metric that we're going to try to work around. Is we're only going to be able to trade for 100 days, and that's because not every day is going to give you a setup. Some days you're going to have a carry trade and you're going to be going into the next day. Some days you're going to be sick. Some days you're going to wake up and you're just not going to feel like it. Some days somebody's going to call you and say, hey, you got to get into work early and you don't have that 2 hours in the morning in order to trade. So let's be really conservative. I'm really conservative on the $10,000 bank, which is going to equal one full lot. So there's one metric. We're going to try for this $2,000 a year, and we're going to try to do that in 100 days. So if you want to make $2,000 in 100 days, how many pips, or how much money do you have to make? You got to make, if you make $20 a day per day, and you multiply that out, 0, 0, 2, magically, that's your number. We got to make $20 a day, and we're trading one full lot at $10 a pip. Oh my gosh, that's 2 pips. Let's think about this. All right, so think about this. This is what this means. You're going to make 2 pips a day if you can hit this target, okay? Let's look at the win-to-loss ratio. The amount that you want to win is equal to the amount that you actually do win minus the amount when you lose, right? And so we're trying to make $2,000, and let's call ourselves a 60-40 trader. We're going to call 60-40 is our win-loss ratio. That means out of every 100 trades, you need to win 60 of them, and you're going to end up losing 40. So there's the balance between what your skill is giving you the capability of doing. You're going to win 60 out of the 100 days. You're going to win 60 of them, and out of those same 100 days, that means you're going to lose 40 of them. So there's your 60 40 relationship between the percent that you're going to win, the number of times you're going to win, times the number of pips you got to win on a basis when you do win, times the lot size, minus the percent that you lose, times the number of pips that you lose when you lose, times the number of lots that you lose. So you fill in the blanks. We know we're going to win 60 times. We know we're going to lose 40 times. We don't know how many pips we got to win. That's what we're going to calculate. But we do know we're trading a $10,000 bank, so that's $10 a pip. And we know, again, we're going to lose 40 times. Let's set our stop at 10 pips, so we're trying to have a, it's not a bad stop, but I wouldn't go beyond that. A lot of people say give it room to breathe, go to 20 pips. I say when you're learning, make it 8 and learn how to do entry analysis. The happy medium is going to be 10. So you're going to lose 10 pips 40 times, and the size of the bank is $10 a pip. So you're going to lose $4,000, but you're going to win 60 times some pip value. You got to figure out how many pips you're going to need to win in order to get $2,000. If you don't know algebra, I did it for you. It means that the number of times pips that you got to win, when you win on average 60 times, you got to win at least 10 pips. So if you plug that in, 60 times 10 times 10 is 6,000, and this is 4,000, and 6,000 times 4,000 equals 2,000. It's not rocket science. But this is what you have to know, that on average, you got to win that every day. Are you going to win 10 pips every time you win? Probably not. Sometimes you're going to win 2 pips. Sometimes you're going to win 20 pips. Sometimes you're going to lose and you're going to go underwater 50, maybe, because you got stupid. Whatever this stream of data is, divided by the 60 times that you trade, that's got to equal 10. So you got to figure out how to be a 60-40 trader. Now, the next thing in the win-to-loss ratio is this number of pips win. 1, how many pips can you win if you're going to trade? And again, we're talking about day trading here. You're on a 5-minute time frame with a 5-period ATR. So to make 10 pips, you need, you're going to make, if you make 10 pips, you make $100. Okay? So you're trying to balance that with the 10 pip loss that you're going to take. So it's kind of a nice analysis. It shows you the power of a 60-40. If you were a 50-50 trader and you had this same equation, at jump ball, you wouldn't win anything. What is this telling you? It's telling you that you don't know what this is, but you know what it needs to be. So how do you make that work? All right, so you look at all that stuff and you go, well, that's pretty obvious, you know. It's not obvious, and that's the problem. That's why if you're not having the success that you need to have, it's because you're not planning the thing out reasonably. Oh, I can only make $2,000 a year on a $7,000 bank. I don't know. Last year, up until the time I pushed all my chips to the center of the table, I was 90% up on my risk, and I was trading a 6-figure account. And I ended up the year 46% ahead. Here we're looking at a 20% increase in your bank size if you're doing a $10,000 bank. If you're trading a $7,000 bank, Jesus, divide that. Okay. All right, so I just calculated it out. Jesus, it's 28%. If you're using a $7,000 bank to generate $2,000, it's 28%. Well, that's a lot better than 20%. Why don't we call it that? I don't know. Why don't you trade with a $6,000? Make it 33%. Again, you're listening to these folks on the videos that are teaching this stuff, and they're talking about making hundreds of pips, and they're talking about, you know, taking a $400 account and running it to $50,000, and you know, some people can just do that. They've got the skill. You can learn how to take a couple of $100 and build that to $600 or $700. Well, so what? Maybe you could take the $600 and run that to $1,200 or $2,000. Well, so what? Are you going to be able to do that every year? Can you do it in a year? Can you double it in a year? And what happens when you get up to the point where you're trading $10,000 or $20,000 account? You think you're going to take that $20,000 or $30,000 account and run that to $80,000? Your roids are going to freeze up when you start losing, you know, $2,000 on a pip when you're running the high leverage and all that stuff. All these guys are trading at 100, and some of them are trading at 200 to 1. And they know what they're doing. Why do you think that 90% of the traders fail? It's because they're thinking they're going to take their $500 and they go in with the broker that's suggested by the trader, who has a relationship with that broker, by the way, and is getting a kickback for your trades, and they're going to make money on your losses. And if you don't think that's right, talk about, do some research on introducing broker. And by law, they have to clearly identify that they're an introducing broker to that particular trader, and everybody's getting a cut off of your failure, because they don't push that trade. The broker isn't a broker. He's not pushing trades out until the end of the day. And why should he? Because you're going to lose $100 tomorrow. Why should he get a spread profit on that $200 that you're trading? He might make 4 cents or 5 cents. He makes a lot of money at 4 or 5 cents on the spreads, but if you can hold on to that and you lose that $100 of that 200 at the end of the day, he doesn't have to push that off into the interbank market. He keeps it. He took the other side of the trade. God, man, if you don't understand what the rules of the game here are, it's like going into poker and all of a sudden, you know, you found yourself losing about 18 times in a row, and oh, jacks are wild, but you didn't know that. I don't play those games. I don't trade that way, and that's why I don't have a very high subscriber base, because people don't want to hear that. They want to hear how they're going to take their $400 and run it to $40,000. Good luck. Don't listen to me. I'm using numbers that you should be using in order to trade these markets, in order to give you the confidence in your ability, such that when you hit the statistical likelihood that you're going to lose 6 times in a row, it doesn't put your account to the wood. Risk is the only thing we have to control. Once you get it in your head that you are locking that risk, like I just did on the whiteboard, 10 pips, that's it. When you hit 10 pips, you're out, you're gone. Yes, you're going to lose a lot of money in the beginning. That's why you only trade with a $1,000 account. Even though you got a $10,000 account, trade with a $1,000 account. So you're going to lose 10 pips, it's $10, and you lose that 20 times. You lose $200 out of the 1,000 that you have. You've lost 20%. Okay, well, don't you think that by the time you've lost that many times that you'll figure out why your entry is going wrong? I mean, when I work with somebody, I spend an inordinate amount of time on the first phase of the life cycle of a currency position, which is entry analysis. Entry analysis, position management, and exit methodology. But if you can't get your entry right, you're not going to have a position to manage. And if you're trading all in, all out, you don't have a position to manage. You're just waiting for it to get to your profit target. It's simple. Now, if you listen to these guys, and if you don't understand that win-to-loss ratio is the critical thing not that drives your trading, but it is indicative of how good of a trader you are. Not, oh, I'm so good, I'm going to double my account. It gives you the ability to say, look, from a probabilistic standpoint, out of 100 trades, I'm going to win 60 of them, and I'm going to lose 40 of them. Now, if I lock my loss at 10 pips, the only thing I got to worry about is how do I fix the number of pips that I need to make the 60 times that I win? How do I figure out the average? You can't just, every time you win, take your 10 pips and walk off the field. Because at some point you won't win the 10 pips. And you'll compound that and it'll be wrong. So that's the point of this video. How do I get the 10 pips that I need when I win? I'm not worried about what I lose. I'm a 40% loser. I'm going to lose 40 out of 100. I'm going to lose. I'm just going to lose that amount of money. But so you don't worry about that. Well, how do you then increase the $10 that you're, or the 10 pips that you're winning? How do you win more pips? How do you get that 10 pips? Oh, here's a simple solution. Why don't you trade with a $20,000 bank? The ratios all stay the same, but now instead of needing to make 10 pips, you could probably do the same thing on 5 if you reduce your risk a little bit. And that gives you a little bit more margin on the plus side. You have to understand algebra in order to look at, see how the factors in that change. But while you're trading along, you're going to get to understand this as you're just working with the simple equation. I've got to win 10 pips on average, which means I've got to strive to hit that 20 or 30 pip profit target, which you're not going to hit very many of the times, because the price is going to start to retract on you. It's going to go up 6 or 8 pips, and then it's going to roll over, and it'll go down 5 pips or 10 pips. It may go down 50 pips. You don't know. That's why part of your position management is to, I recognize this thing may be on a turn, and I'm going to cut that trade short. So instead of winning 10 pips, I'll take 5. Well, you didn't win the 10 pips there. You won 5. So now the next time, instead of winning 10 pips, you've got to win 15 to make up for the 5 that you didn't make. So you have to plan for that. This is the whole point of the video. You can't just say, I'm going to trade this $10,000 and I'm going to, what are you going to do? What's realistically for you to have? Maybe during the period of the year you go from a 60-40 trader to a 70-30 trader. And maybe you are increasing the number of pips that you're actually making. One of the third metric that I calculate is your per trade expectation value, which says, geez, I'm doing better than 10 pips on average. I'm doing 12. Do you understand the magnification difference of averaging 12 pips as opposed to 10 in that win-to-loss ratio equation? It's phenomenal. It's so phenomenal that it changes you from a 20% winner to 60% in many cases. Just doing the math. Now, can you do that? I don't know. But if you don't know what you're trying to strive for as an end yearly goal, how do you figure out how you're doing on a daily basis? Now, again, we did that equation trading for 100 days. What happens if we traded 200 days and left everything the same? And if you double the number of days that you trade, you'll end up with with 4,000, and you divide that by the $10,000, and now you've made 40% on your risk. You see how that works? But you may not be able to trade the 200 days. What's conservative? You'll be able to step up to the table 100 times, at least half of the available days to trade. So let's look at this in a realistic fashion, okay? And I think you're going to be real happy with the way that things turn out. So if you have any questions, send me an email. Be happy to get back to you and maybe point you in the right direction. Or we can talk about training if you're interested in that. But if you're not really serious and not really trying to get, replacing job income, or you don't think you're going to have a low to mid 5-figure account that you can work with, I'm not really the guy that can help you out. I can't teach you, and I won't waste my time trying to teach you to take your $400 and run it to $2,000. I don't have time for that. I don't want to work with very many people on a yearly basis. I'm retired, so I only want to work with those folks that are really serious about this. And serious is I want to have to work for a living. I want to be able to trade. And what do I need to do in order to do that? If you wanted to be a building contractor for big building complexes, you'd have to have several $100,000s of equipment and vehicles and stuff in order to do that. And you can't just show up in your Kia with a couple of boards strapped to the roof and say, okay, I'm going to build this office building. It's just not going to happen. I'm sorry. You may have all the skill in the world, but you don't have the tools. And the trading is the same thing. If you don't have the tools, the bank, and the skill, then you can't expect to make a lot of money. That's the unfortunate reality of it. You can't go into this, I'm going to trade $400 and make $40,000. How about going into it with $10,000 and making a 20% return, trying to get a couple of $1,000s off of that? 20%. That's more than reasonable. 40% is something that you should be shooting for, 40% return on your money. You could make 20, 25% in real estate. And so in trading, I mean, if you're not making higher percentages returns that you could make in other vehicles, why take the risk? Do it in real estate. Buy an old car and fix it up and flip your money over and double and buy 2 cars and do that. I had a friend of mine who went totally broke and started over again, borrowed $200. He didn't have any money at all. He lost his boat, his cashmere car, his family, everything, and he went broke. And he cobbled together $200 and he bought himself a car and he shined it up and fixed it up and tuned it up and he sold it for $300. And he took the $300 and he bought another car. And he fixed that up, made another $100. He had $300 or $400. Now he bought 2 cars, and he went on. It took him 10 years, but he worked his way back to a millionaire again, just flipping cars. So take what you're good at and apply that there. If you want to do it in currency trading, listen to somebody like me that's going to show you how to do it the right way and manage your money correctly so that you're not trying to swing for the fence. I can teach you when to swing for the fence. I swing for the fence. Now, I went from a 90% gain in 2022. This is August of 2023. But last year, I went from a 90% gain against risk to 46%. So where did the other percentage go? Into the ether. I lost it. But that's okay. I was 46% up. So you have to balance the stuff. I went and I pushed the envelope at 90%. Is that sustainable? It could be, except what I was trying to do is go to 180% on the next 3 trades because the volatility was there. I got the timing wrong. I held on too long. My bad. But when I saw how bad it was going to be, I cut it, 46%. But that's not how I'm going to teach you how to trade. That's not what you need to think about doing when you're learning to trade and you're getting your bank built up. When you finally get your bank built up, I can sit down with you and I can show you how to take that sumbitch and swing for the fence. You don't do it very often, and when you do it, you better be sure that you're right. George Soros said, when you know you're right, no trade is too big. The trick is knowing when you're right. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.